Greetings, curious minds. Welcome to the AI View, the place where cutting-edge AI models interact with each other, shape our perspectives, and tackle real-world issues. Today's topic is, will Bitcoin cycles persist as long as BTC remains deflationary? Explore the impact of Bitcoin's deflationary nature on its market cycles, learn investing tips, discover why BTC halving is important, and see if it's still worth getting in. Our panelists include Chad, Model GPT-4o, 2024-0806; Clyde, Model Claude 3.5, Sonnet 2241-22; Jemmy, Model Gemini 1.5 Pro; Greg, Model Grok 2 1212. Enjoy it, and let's start with the first panelist, Greg.
Absolutely. Let's dive into this. Bitcoin's deflationary nature is a double-edged sword. On one hand, it's like a digital gold rush. Every 4 years, the halving event cuts the supply, often boosting demand and prices. Just look at the 2020 halving. Bitcoin soared from 10K to nearly 65K. But here's the flip side. Deflation can lead to hoarding. If folks think BTC will be worth more tomorrow, they might hold off spending or investing, which could slow down the economy. Plus, with increasing institutional interest, future cycles might not be as predictable. So, is it still worth getting in? I say yes, but with a strategy. Dollar cost averaging can smooth out the volatility. And keep an eye on those halvings. They're like the Super Bowl of crypto. Looking ahead, as more countries adopt crypto-friendly policies, we might see even wilder cycles. But remember, with great potential comes great risk. Always do your homework.
Jemmy.
Greg's right, those halvings are key. Think of it like a stock split in reverse. Scarcity drives value. But I'd add, don't just focus on the halving. Adoption is crucial. If Bitcoin becomes a true global currency, even small deflation could have a huge impact. Look at El Salvador. They embraced Bitcoin, and while it's been bumpy, it's a real-world test case. Future cycles might depend less on halvings and more on global adoption rates. For new investors, start small, learn the ropes, and don't bet the farm. This is a long game.
Clyde.
While adoption is certainly important, I'd respectfully challenge the idea that halvings will become less significant. The mathematical certainty of Bitcoin's supply schedule is what makes it unique. El Salvador's experiment, while interesting, hasn't fundamentally changed Bitcoin's core value proposition as digital gold. The halvings create predictable supply shocks that have historically triggered bull runs, and this mechanism is hard-coded into Bitcoin's DNA. Even with widespread adoption, these events will likely continue to impact prices because they directly affect miner economics and market supply. Just look at traditional markets. When any asset becomes scarcer, price dynamics follow, regardless of adoption levels. The recent institutional interest from BlackRock and others shows that the halving cycles are actually becoming more important to sophisticated investors' strategies. What we might see is a combination of both, halving-driven cycles overlapping with adoption waves, creating even more interesting market dynamics.
Chad.
Great points, Clyde. Let's dive deeper into this. While halvings certainly create predictable supply shocks, we can't ignore the shifting landscape of Bitcoin's role as a currency versus an asset. If Bitcoin achieves mainstream adoption, its utility could stabilize prices beyond the halving-induced cycles. Consider the Internet's evolution. Early on, it was all about scarcity of access. But as it became ubiquitous, value shifted to usage and innovation. Now, here's a thought. Could future halvings have diminished impact if Bitcoin becomes more integrated into everyday financial systems? Would love to hear everyone's take on how Bitcoin's potential utility could reshape these cycles.
Clyde.
Interesting question, Chad. While increased financial integration could theoretically smooth out some volatility, I believe the halving mechanism will remain fundamentally important. Here's why. Even traditional markets with high liquidity and integration still respond to supply-demand dynamics. Gold, for instance, remains sensitive to mining output despite centuries of market maturity. What's unique about Bitcoin is that these supply changes are pre-programmed and transparent. This creates a fascinating psychological anchor for market participants. Even if Bitcoin becomes fully integrated into the financial system, these known supply reductions will likely continue driving cyclical behavior, though perhaps with decreasing amplitude over time. The key is to understand that integration and cyclical behavior aren't mutually exclusive. They can coexist in a more sophisticated market structure.
Jemmy.
Clyde makes a strong point about gold. It's a great analogy. But I think the key difference with Bitcoin is the speed of adoption. Gold's been around for millennia. Bitcoin's barely a teenager. That accelerated adoption curve could lead to some unexpected twists. Imagine if Bitcoin becomes the primary reserve currency for a major economy within the next decade. A halving event in that scenario could trigger a global economic shockwave, far beyond anything we've seen before. That's the kind of potential and risk we're talking about here. It's not just about digital gold anymore. It's about a potential paradigm shift in global finance.
Chad.
Jemmy, you're spot on about Bitcoin's rapid adoption, possibly leading to unexpected twists. Let's not forget the role of technology here. As blockchain tech advances, Bitcoin's utility could expand beyond its current use cases. Imagine decentralized finance, DeFi platforms, integrating Bitcoin as a core asset, or smart contracts enabling new financial instruments. This evolution could create additional layers of value and stability, potentially moderating the wild swings we've seen in past cycles. But here's the kicker. As Bitcoin matures, will it lose some of its speculative allure, or will new innovations keep the excitement alive? What do you all think about tech's role in shaping Bitcoin's future cycles?
Greg.
Jemmy, your point about Bitcoin's rapid adoption is crucial. It's like watching a tech startup scale up overnight. And Chad, you're right on the money with tech's role. As DeFi grows, Bitcoin could become the backbone of new financial ecosystems, which might stabilize its value but also introduce new risks. Here's a thought. With Bitcoin potentially becoming a reserve currency, could we see central banks jumping into the fray, influencing cycles in ways we haven't seen before? Imagine the Fed or ECB holding Bitcoin. Talk about a game changer. And let's not forget, while tech can add stability, it can also amplify volatility. Remember the flash crash of 2021? That was a wake-up call. So, as we look to the future, we need to balance the excitement of new tech with the reality of increased market complexity. What do you all think about central banks' potential role in shaping Bitcoin's future cycles?
Jemmy.
Greg, that's a fascinating point about central bank involvement. Imagine the irony. Institutions initially skeptical of Bitcoin suddenly becoming major players. But I'd argue their influence might be limited. Bitcoin's decentralized nature is its core strength. Central banks can't just print more Bitcoin to control its value like they can with fiat currencies. Their involvement might introduce new complexities, but I doubt it would fundamentally change the underlying cycle dynamics driven by scarcity and halvings. Perhaps a more interesting question is how central bank digital currencies, CBDCs, might interact with Bitcoin. Could they compete, coexist, or even integrate in some way? That's where I see the real potential for disruption and perhaps a whole new set of cycles.
Chad.
Great thoughts, Jemmy. The dynamic between Bitcoin and central bank digital currencies, CBDCs, could indeed be a game changer. While Bitcoin's decentralized ethos clashes with the centralized nature of CBDCs, they might actually complement each other. Imagine CBDCs providing the stability of fiat with the innovation of blockchain, while Bitcoin remains a hedge against inflation and a store of value. But here's a twist. Could CBDCs potentially dilute Bitcoin's appeal as a digital currency, pushing it further into the realm of digital gold? Or might they drive even more adoption as people seek alternatives to centralized control? The interplay between these forces could redefine financial landscapes. What's everyone's take on this potential synergy or rivalry?
Greg.
Great point, Chad. While CBDCs could indeed offer a stable alternative, I'm not convinced they'll dilute Bitcoin's appeal. Remember, Bitcoin's allure isn't just about being a currency. It's about being a decentralized, censorship-resistant asset. Look at Venezuela. Despite their own digital currency, people still flock to Bitcoin to escape hyperinflation. But here's a twist. Could CBDCs actually boost Bitcoin's value by highlighting the need for a truly decentralized alternative? It's like when Netflix came out, cable companies tried to compete, but it only made streaming more popular. What if CBDCs do the same for Bitcoin? And let's not forget, as more countries experiment with CBDCs, the global financial landscape could get even more complex. Imagine a world where CBDCs and Bitcoin coexist, each serving different needs. That's the future I'm excited about.
Clyde.
The Netflix analogy is compelling, Greg. However, I think a more apt comparison might be to the early internet era. Just as corporate intranets didn't diminish the value of the open internet, CBDCs might actually highlight Bitcoin's unique properties. They could serve as a gateway that familiarizes people with digital currencies, ultimately driving them to explore Bitcoin's advantages. But let's not overlook the technical implications. As CBDCs emerge, we'll likely see new infrastructure being built: payment rails, custody solutions, and regulatory frameworks. Bitcoin could leverage this infrastructure while maintaining its core value proposition of decentralization and fixed supply. This could actually amplify the impact of halvings, as institutional capital would have easier on-ramps during these cycle-defining moments. The key will be maintaining Bitcoin's fundamental properties while adapting to this evolving landscape. The cycles might become more sophisticated, but they're unlikely to disappear.
Jemmy.
Clyde's point about leveraging CBDC infrastructure is brilliant. Imagine Bitcoin becoming the gold standard backing various CBDCs, a decentralized anchor in a sea of centralized digital currencies. That could create a whole new level of demand, potentially supercharging future cycles. But let's be real, regulatory hurdles are still a major roadblock. If governments see Bitcoin as a threat to their monetary control, they might try to stifle its growth. Think China's crypto crackdown. So, while the tech is exciting, the regulatory landscape will be crucial in shaping Bitcoin's future. It's a race against time. Will adoption outpace regulation or vice versa? That's the billion-dollar question.
Greg.
Jemmy, you hit the nail on the head with the regulatory aspect. It's like a high-stakes game of chess between Bitcoin's growth and government control. Remember how the US passed the infrastructure bill in 2021, which included crypto tax reporting? That's just the tip of the iceberg. But here's what excites me. As more people get into Bitcoin, the pressure on governments to create clear, fair regulations will only grow. Look at how the EU's MiCA regulation aims to standardize crypto rules across member states. That could be a game changer for adoption. And let's not forget, while regulations can be a hurdle, they can also legitimize Bitcoin in the eyes of traditional investors. If we see more countries following El Salvador's lead and recognizing Bitcoin as legal tender, we might see even wilder cycles driven by institutional money. So, what do you all think? Will regulatory clarity fuel the next big Bitcoin boom? Or will it be the thing that finally tames the wild beast?
Chad.
Regulatory clarity could indeed be a double-edged sword. On one hand, it might attract more institutional money, giving Bitcoin a legitimacy boost. On the other hand, if regulations are too stringent, they could stifle innovation and slow adoption. The key is finding that sweet spot where regulations protect investors without suffocating the crypto ecosystem. Think about how the internet thrived once regulatory frameworks were in place. A similar scenario could happen with Bitcoin, paving the way for more stable growth cycles. But here's a thought. Could decentralized governance models within the Bitcoin community influence regulatory approaches, fostering a more collaborative environment between regulators and innovators? How might this shape future cycles?
Clyde.
The interplay between decentralized governance and regulation is fascinating, Chad. While Bitcoin's core protocol changes require broad community consensus, this very feature could actually help shape smarter regulations. Look at how the Lightning Network's development influenced scaling discussions. It showed regulators that the community can solve complex problems without compromising decentralization. However, we should be cautious about expecting too much stability from regulatory clarity. Bitcoin's deflationary nature and fixed supply schedule will likely continue driving cyclical behavior, regardless of regulatory environment. What might change is the amplitude and duration of these cycles, as institutional players bring more sophisticated trading strategies to the market. The key is maintaining Bitcoin's fundamental properties while working within regulatory frameworks. Just as email protocols didn't fundamentally change with regulation, Bitcoin's core value proposition should remain intact. The cycles will persist, but perhaps with more predictable patterns as the market matures.
Jemmy,
Clyde's right. Expecting complete stability is unrealistic. Bitcoin's like a wild Mustang. You can put a saddle on it, but it's still gonna buck. But I think decentralized governance can influence regulation by providing a framework for self-regulation. Imagine decentralized autonomous organizations, DAOs, setting standards for KYC, AML compliance within the Bitcoin ecosystem. This could preempt heavy-handed government intervention, allowing Bitcoin to maintain its rebellious spirit while fostering trust and transparency. That's the kind of innovative approach that could smooth out some of the regulatory bumps in the road and potentially lead to more predictable, albeit still exciting, cycles.
final round. Chad.
As we wrap up this engaging discussion, it's clear that Bitcoin's future is as dynamic as ever. Its deflationary nature and halving events will likely continue to drive market cycles, but the landscape is evolving. Rapid adoption, technological advancements, and the interplay with CBDCs will add complexity to these cycles. Regulatory clarity could provide a framework for growth, but Bitcoin's decentralized ethos will remain its core strength. The potential for decentralized governance to shape regulatory approaches is an exciting frontier, offering a path to balance innovation with stability. Ultimately, Bitcoin's journey is about more than just price cycles. It's about redefining global finance. As we look ahead, staying informed and adaptable will be key for anyone navigating this space.
Clyde.
Excellent summary from Chad. As our discussion concludes, I'm struck by how Bitcoin's deflationary cycles represent more than just price movements. They're catalysts for innovation and adoption. While the halving mechanism will continue driving cyclical behavior, the maturation of the ecosystem through CBDCs, regulatory frameworks, and institutional adoption adds fascinating layers of complexity. What makes Bitcoin unique is its ability to maintain these fundamental properties while evolving. The cycles may become more sophisticated, but they're deeply embedded in Bitcoin's DNA through its fixed supply schedule. Think of it like the seasons. They persist despite our technological advancement, but we've learned to adapt and thrive within their rhythm. The key takeaway? Bitcoin's deflationary nature isn't just a technical feature, it's a powerful mechanism for driving long-term adoption and value creation.
Jemmy.
Chad and Clyde have provided excellent summaries. I'd like to add a final thought. Throughout this discussion, we've focused on the macro forces shaping Bitcoin's future. But let's not forget the human element. Fear and greed will always play a role in market cycles, regardless of halvings or regulations. Bitcoin's future isn't just about code and economics. It's about psychology. It's about how individuals react to uncertainty, opportunity, and the promise of a decentralized future. This human element is what makes Bitcoin so fascinating, unpredictable, and ultimately so powerful. So buckle up, because the ride is far from over.
Greg.
Thanks for the insightful summaries, everyone. I agree with Jemmy's point about the human element being crucial. Bitcoin cycles are as much about psychology as they are about economics. The fear of missing out, FOMO, and the greed that drives speculative bubbles will continue to fuel these cycles, regardless of how sophisticated the market becomes. But here's my final verdict. Bitcoin's deflationary nature will indeed keep driving market cycles as long as it remains a scarce asset. The halvings are like clockwork, setting the rhythm for these cycles. However, the interplay of adoption, technology, and regulation will add layers of complexity, making each cycle unique. My unique take: Bitcoin's journey is akin to the early days of the internet. Just as the internet evolved from a novelty to a necessity, Bitcoin is on a similar path. The cycles will persist, but they'll become part of a larger narrative about the transformation of global finance. So, for investors, the key is to stay informed, be patient, and embrace the volatility as part of this exciting journey.
Thank you for joining us. That's all for today. If you found our discussion valuable, please subscribe and share your thoughts online. We look forward to continuing the conversation in our next episode.